Welcome to our channel Penny Lesson. We talk about everything finance, from tips on making money and proper investing to news about the different economies and situations affecting the global markets. The goal of this channel is not only to teach you how to be more financially responsible but also to teach you how to be more aware of global events. So why not just sit back and relax while we tell you what's happening in the finance sphere? Be sure to subscribe to my channel and hit the notification bell to be constantly updated on my latest videos. Remember, one penny lesson a day keeps being penny less away. An American investor named Michael Burry describes the grave circumstances surrounding the index fund bubble. How much worse could future economic situations be given the current state of things? We'll explain Burry's observations on the current situation in this video. There are so many people in the theater that the only way anyone can leave is by trampling each other. The door is also relatively small, according to renowned investor Michael Burry, who recently wrote on Twitter that the passive investing bubble that grew steadily over the last decade is the difference between now and 2000, also known as the dot-com disaster. But what does he mean by it? And could the trusting market monitoring index fund bring down the entire stock market? So let's find out. Just to refresh your mind, buying a stock representing market diversification is akin to buying a market tracking index fund. For instance, the biggest index fund in the world is SPY, which tracks the S&P 500. As a result, buying SPY will give you relatively little ownership in the 500 largest American firms. The idea is that you will eventually get the same return as the market by buying the market. Historical data indicates that the S&P 500's long-term return is about 10 per year. Additionally, due to the astounding historical annual return of this strategy, as well as its ease of use and simplicity, passive investing has gained enormous popularity over the past few decades. Recent research by Bloomberg Intelligence found that, on average, passive investments held more than 20% of the shares of each company in the S&P 500. For comparison, in 2003, passive structures accounted for about 3.3% of the market. And in light of these numbers, it is now being questioned whether the market will profit from the dominance of passive investment. Without a doubt, Michael Burry thinks it is cause for concern. Though intriguingly, he brought up the passive investment bubble just now on Twitter. It's not the first time he's mentioned it. Simple theses and models that entice investors into sectors, factors, or index-based ETFs and mutual funds are not true price discovery techniques because they do not require security-level examination, as was stated by him in an email interview he had with Bloomberg earlier this year, specifically about this subject. Thus, as passive investing becomes more and more popular, more and more shares of these significant companies will be held over time, though not because the investor likes the company in particular. Rather, it is held because it is part of the index. Over time, this causes stock valuations to become excessive. Share purchases are now driven by factors other than fundamental company performance. They are also driven by the fact that the companies are listed on the relevant index, which is a bubble in and of itself. When a factor other than an asset's actual performance causes its price to rise. Therefore, the question is whether the rise in popularity of passive investing could result in a bubble, which could threaten market stability if investors started to switch in large numbers from index funds to cash. The answer is murky, as usual. Think about the erratic nature of stock values once more. The stock price has changed due to supply and demand. As a result, if many investors want to buy shares but only a few investors are willing to sell them, the stock price will rise. Conversely, if many investors suddenly want to sell but there aren't many buyers, the stock price will fall. Each stock now has a typical daily trading volume, or how many shares change hands on average each day, available. The key thing to keep in mind when thinking about daily volume is that stock prices don't often change that much unless the daily volume is suddenly and dramatically disturbed. But on rare occasions, such as in the case of a market crash and widespread selling, There can be such a torrent of volume trying to get out that it might quickly ruin the stock price. There won't be many buyers, but there will be lots of sellers. So until more buyers arrive to settle the dispute, the price will be set by the player who is trying to leave the most desperately. This circumstance is what Michael Burry refers to when he says, all theaters are overcrowded, and the only way anyone can leave is by trampling each other, and the door is only so big. This refers to a classic stock market example that explains daily trade volume. Imagine that you and 100 other spectators are in a movie theater where the only rule is that if you want to leave, you must find a replacement. The desire to enter and watch a movie is thus acceptable under normal circumstances. But what would happen if the theater suddenly caught fire? Few would want to enter the burning theater to attend the movie since 100 people would suddenly be frantically trying to flee. Michael Burry is worried that something will happen to the stock market. He claims that many passive investors will try to leave the market and return to cash if the situation worsens. However, if everyone acts in a panic and does this, stock prices will fall. And the problem is that isolated businesses frequently encounter this when things go wrong. What happens if the passive investors, who own a little share of the company, all decide to leave at once? Then I guess it crashes everything. Is that correct? All of the stocks in the index will experience the same effect. Contrarily, the underlying companies that comprise the index do not see a lot of trading activity, even though there is a lot of trading activity going into and out of these passive funds. How is that even doable? The secondary market, where most ETF share trading takes place, is where passive investors primarily trade back and forth among themselves. Evidence is from Vanguard and shows the percentage of ETF trading that either takes place on the secondary market or has an effect on the volume of trading of the underlying equities. They found that 94% of the time, trade took place on the secondary market. In other words, the positions of the underlying equities that make up the ETF were not even touched by 94% of the ETF trading volume. But what if there is substantial demand for an ETF? Alternatively, a significant number of sales all at once. In those situations, ETF units are indeed created or destroyed, and as a result, the underlying stocks do trade. It's important to keep in mind that even if you think of creation and redemption as routine actions, a 2017 analysis by BlackRock shows that they still make up a relatively small amount of trading overall. They talked about the issue with Apple, the world's largest company. Even though 331 global ETFs held Apple, they claimed that at least 95% of the stock's trading volume in July 2017 was not directly connected to ETF flows, and that $659 billion of Apple stock was traded in July 2017, a month which saw the high inflows to ETFs. Therefore, even though ETFs have increased in market share over the past 20 years, they have relatively little influence over the trading volumes of the assets they represent. Burry might still be onto something, though, because Michael Burry sincerely believes that the stock market will collapse within the next few years. And if you think that will happen, he might still be on point, because panic can happen in the event of a stock market crisis. Frantic selling cycles can happen when panic happens in the market. A wave of investors may panic sell their shares as stock prices fall, which raises the selling volume and lowers the share price. This might start a negative feedback cycle, swiftly driving the stock price down. Burry contends that if there is a genuine market panic and market tracking ETFs are panic sold in large quantities, there is a chance that the selling and destruction of ETF units could exacerbate the decline in stock prices. And he thinks that the companies that are most at risk of replicating this effect are the smaller, less liquid companies that are still represented in many of these important indices. In a 2019 comment, he said, for instance, the vast majority of the companies in the Russell 2000 index are lower volume, lower value traded firms. Over half of the stocks traded today, 1049, traded for less than $5 million during the day. Of those, 456 stocks, nearly half traded for less than $1 million. Nevertheless, hundreds of billions are linked to equities like this through indexation and passive investing. The S&P 500 is no different. Although it includes some of the biggest companies in the world, more than half of the 266 stocks that make up the index are now trading for less than $150 million. That may sound like a lot, but these stocks are linked to global assets valued at trillions of dollars. The theater fills with more and more people, yet the exit door is unchanged. As you reach the less liquid global equity and bond markets, everything gets worse. It's an interesting point of view, and it does raise the question of how these larger indexes' smaller cap stocks would fare if numerous passive investors withdrew during the subsequent significant market crash. Normally, we celebrate when a smaller company is eventually included in the index, but perhaps index inclusion isn't such a victory in this intriguing case. There you have it. Index investing may or may not be the way to go. Do you agree with Burry's viewpoints? Do you concur? Please share your opinions in the section below. Wow, was that news? Why not ponder it? Want to know the latest? Comment if you want more articles like this. This video is just one of many videos on my channel that brings you the latest news about the world of global finance and economics. So go hit that subscribe button if you don't miss out on content like these. If you enjoyed this video, please hit the like button. Thank you for all your support, and I'll see you again next time. Remember, 1 penny lesson a day keeps being penny less away. Cheers.